program is general in nature. Viewers should seek their own professional advice before purchasing products or services. The producers of this program may receive a fee for commercial arrangements with companies featured in this programming. On Sky News Business, this is Equity Investor with Julia Lee.
Welcome to the program. I'm Julia Lee from Bell Direct, and on tonight's show, signs of rising inflation in the US sparked a global sell-off with $30 billion wiped off the local bourse. Just a blip or further to fall? Analysis up soon. We'll look at Newcrest Mining. It's seen some choppy trade after its latest production report. We'll find out what experts think about the stock and our stock in a minute. A company that's all about Body Beautiful, and it's an app that takes a snapshot of your health with just one swipe of a finger. And my guests tonight, Andrew Page from The Motley Fool and Kim Slater from County Securities. And don't forget, you can reach us at eq@skynews.com or hashtag Equity Investor. And of course, if you want to ask your question live on air, please include a contact number and we'll ring you back. Well, having a look at some of the trending topics, and Boncano. Also, we saw Wesfarmers coming out with impairments to its UK and Ireland business, and Commonwealth Bank. It has its report up on Wednesday. How will the market react? But first of all, let's have a look at the US stock market. We saw US stocks down by 2.1% on Friday, and investors spooked about Boncano, the end of the 30-plus bull market that we've seen in bond yields. Let's ask our panelists what they think is going to happen in 2018. I mean, Andrew, we'll start off with you. They say that bond market investors are smarter than equity market investors, and at the moment we've seen a spike in bond yields. And look, usually that's not concerning because you go back into history, and sometimes when you see rising interest rate, it coincides with a rising stock market. But this time round, you know, a big inflection point on the cards. What do you think?
Firstly, I love the term Boncano. I'm hoping that catches on. But yeah, look, I think investors, equity investors, obviously the smarter investors, need to focus a lot on interest rates. I mean, we determine valuations through interest rates. There is opportunity cost out there, and the higher that rates are, the less attractive that equities are. So there is a very definite correlation there. Markets have been pretty highly
on this program is general in nature. Viewers should seek their own professional advice before purchasing products or services. The producers of this program may receive a fee for commercial arrangements with companies featured in this programming. On Sky News Business, this is Equity Investor with Julia Lee.
Welcome to the program. I'm Julia Lee from Bell Direct, and on tonight's show, signs of rising inflation in the US sparked a global sell-off with $30 billion wiped off the local bourse. Just a blip or further to fall? Analysis up soon. We'll look at Newcrest Mining. It's seen some choppy trade after its latest production report. We'll find out what experts think about the stock and our stock in a minute. A company that's all about Body Beautiful, and it's an app that takes a snapshot of your health with just one swipe of a finger. And my guests tonight, Andrew Page from The Motley Fool and Kim Slater from County Securities. And don't forget, you can reach us at eq@skynews.com or hashtag Equity Investor. And of course, if you want to ask your question live on air, please include a contact number and we'll ring you back. Well, having a look at some of the trending topics, and Boncano. Also, we saw Wesfarmers coming out with impairments to its UK and Ireland business, and Commonwealth Bank. It has its report up on Wednesday. How will the market react? But first of all, let's have a look at the US stock market. We saw US stocks down by 2.1% on Friday, and investors spooked about Boncano, the end of the 30-plus bull market that we've seen in bond yields. Let's ask our panellists what they think is going to happen in 2018. I mean, Andrew, we'll start off with you. They say that bond market investors are smarter than equity market investors, and at the moment we've seen a spike in bond yields. And look, usually that's not concerning because you go back into history, and sometimes when you see rising interest rate, it coincides with a rising stock market. But this time round, you know, a big inflection point on the cards. What do you think?
Firstly, I love the term Boncano. I'm hoping that catches on. But yeah, look, I think investors, equity investors, obviously the smarter investors, need to focus a lot on interest rates. I mean, we determine valuations through interest rates. There is opportunity cost out there, and the higher that rates are, the less attractive that equities are. So there is a very definite correlation there. Markets have been pretty highly priced for quite some time, and the justification has been, yes, but it's lower for longer. We need to have these higher valuations because of this expectation. Now, it seems, you don't want, one swallow does not a summer make, but it seems as though the narrative is very much shifting towards interest rates going up a lot faster and sooner than people expected.
I think the interesting thing about this whole Boncano thing is we're actually moving from negative interest rates, which we've never ever seen. So we had all the qualitative easing by the central banks, which had real interest rates at a negative. Now interest rates are turning the other way, so we're seeing a flood of market money coming out of those negative yields, and it's got to go somewhere. So it's going into the longer end of the bond market.
I mean, the amazing thing about this, Kim, is that, the bond market that we've seen in terms, the bull market that we've seen in bonds has spanned pretty much your whole career.
I think there's a lot of people in the market that have never seen conditions like we are about to see with rising interest rates, because when you look at the yield curve, it's been flat for so long. Now we're starting to see the 20 and the 30 year and the 10s all starting to kick up, and that really is a normalisation that we haven't seen for a long time. So the real thing is, what does it mean for interest rates? Well, if you're borrowed, and everyone is borrowed, it means you're going to be facing higher interest rates this year, and that's going to impact on equity performance.
So just quickly before we go on to our first email, given the, spike in volatility that we've seen in the markets, is it too early to buy now? Are you buying now? Or are you worried about the equity markets at all in 2018, Andrew?
Look, I've been worried for a little while. As a longer-term value-focused investor, things have looked pretty exy for a while for me. So, yeah, look, I don't think I'm going to change stance overnight because of what's happened, but it definitely sort of plays to that concern.
Kim, opportunity or time to look at
I think it's
selling?
a bit like being in the gelato shop and trying to work out which flavour that you want. I mean, there's value in the equity market in these sort of situations. So, you know, your preference might be lime, someone else's might be pineapple.
Is there a bull flavoured ice cream?
A buff. I hate to think what it would taste like, Julia.
Like a steak?
Steak and red wine, perhaps. But these markets often throw up opportunities when you get mispricing, and that's where you've got to move. Now, there's probably, you know, these aren't just one down days. There's a rolling cycle of them.
Okay, time for our first email of the night, and this one is from Josh in Manly, New South Wales, and he says, I'd like to hear the panel's view on TPG and Treasury Wine Estates. Great question coming through there. And I guess two very different stocks that Josh is asking about. One has absolutely shot the lights out, that's Treasury Wine Estates, and the other, TPG, hasn't been doing so well. But let's start off with Treasury Wine Estates, given that we've got the chart up here on the wall. Treasury Wine Estates, I mean, reached an all-time record high once again last week. It's in this upgrade cycle. And I guess one of the beautiful things about a stock like this is not only does it sell wine, but when it sells wine to Asia, it sells it at a premium. So having a look at the prices it sells to China, $5.58 a litre, compared to the US, where it sells at $2.51 a litre, and then Hong Kong, $14.48 a litre. But there's some pretty nice margins there. Kim, can they retain these margins and maybe even increase, or have we seen the peak?
I think the interesting thing about this stock is what it's doing in the US. So the whole logistics business has changed in the US with being able to move wine across borders. Normally it was restricted by the various states having their own legislation. This opens up a whole new market for Treasury, and there's even talk that Treasury could make an acquisition in the States. So they're talking about, you know, perhaps making a bid for Robert Mondavi. It's got the strength in the balance sheet to do it. The multiples are really, really high. So the sensible thing to do would be to use scrip to make a takeover bid.
Okay, so looking for a takeover and acquisition here. I mean, in terms of Treasury Wine Estates, it's one of these fascinating turnaround stories because, you know, not all turnarounds come good. In fact, most of them don't, Andrew, and you'd probably know that being a value investor. But this has been one of them that has just had phenomenal gains, a great turnaround. You know, how do you know when there's an inflection point in, you know, the good news?
Well, I can jump in. I'm old enough to remember when Treasury was spun out of Foster's and everyone received it, and the investment community said, was asked by their clients, what do you do with it? And everyone said, sell it, it's a piece of crap. But, you know, if you'd held on to it,
Well, it was a basket case back in the day, but management have this wonderful strategy. So it's about getting costs out, it's about focusing on the high margin wines, and they are executing brilliantly. So even in the first half, we saw revenue down, I think, about 2%, and yet earnings are growing strongly. And they're still calling for very, very strong earnings growth for at least the next couple of years. So this is, I think they've got some wonderful brands, they've got a good, clear strategy, they're executing well.
Would you be buying at these prices, Andrew?
Personally, I wouldn't. And it comes back a little bit to how we started the show, talking about how we're just valuing things on the market at the moment. But even if you throw that earnings growth forward for a few years, even if you give it a high multiple, it's 39 times at the moment. And there is, look, at the end of the day, is even though they've got some great brands, this is a wine producer in a highly competitive global market. Okay. So for me, it's a bit too expensive.
So neither of our panellists like the high multiples here. Great business, but, you know, it's probably mostly priced in here. What about TPG? Other end of the spectrum, where we've seen a lot of volatility in terms of the share price. And in fact, the shares over the last 1 year, it looks like almost a V shape. So basically flat over the last 52 weeks. I know Credit Suisse has a sell on this stock at the moment, saying that earnings are expected to go backwards for around about 3 years. Andrew, do you like TPG?
Look, I do. I think things got a little bit carried away there, and the whole sector was just getting carried away because there was this wonderful growth, but it was all through aggregation, and that story's come to an end now. So, so the market was right, I think, to come back. You know, the analysts are right. Earnings are going to be depressed because TPG's building for the long term here. They're building network in Australia and over in Singapore, and those are very expensive endeavours. So I think this is fairly priced if these assets that they build actually get a good return on investment, it's actually a very attractive one, a very attractively priced share. If not, it's not. And that's the hard thing to determine, which is why we sort of look to management, which are very strong, and I'd be prepared to give them the benefit of the doubt.
So the question is, would you be buying TPG here, or do you wait till the peak of the mobile spend, which is in a couple of years, maybe 18 months, 24 months?
Well, I think the interesting point here is it's broadband versus mobile. So you look at Telstra, they're introducing 5G. So everyone's actually downloading now on broadband with the NBN. So the average download's 200 gigabytes versus mobile, which is 3. So mobile's a lot more expensive. But Moore's law comes into account here, because as mobile gets better, quicker, faster, it'll get cheaper. And I tend to think that mobile is going to leave broadband for dead.
I mean, the problem is that we all know that we're using more data, but that data is becoming cheaper. So,
Correct.
you know, the telecom companies, yes, we're seeing an increase in volumes and demand, but prices have come right down.
And they're having to run to stand still on the spot. So that's why I think you've got to really, with stocks like TPG, you've just got to watch and wait for that inflection point. So, you know, don't be surprised if you may not see an earnings downgrade come through.
Okay, so that was Treasury Wine Estates and TPG. The next email comes...
No, I think it's pretty fair.
Sheriff, I would like the panel's view on Newcrest Mining. Is there more room for the share price to move higher? Now, we received this email last Monday. On Tuesday, the company released its quarterly production report, which saw gold output jump 17%. But, of course, Lihir disappointing, and in the second half, we need to see improvement there to meet FY18 guidance for Lihir. And I find it absolutely fascinating that, you know, in a week where we've seen such volatility in terms of market, you'd think that gold is a safe haven area. But in fact, gold stocks tumble with the rest of the market, and the gold sector has been sold off quite heavily. Kim, looking at Newcrest, this has been one that's been in the dog basket for a while. It's coming back a little bit. What do you think first of gold and Newcrest Mining in that picture?
Well, gold I still think has got a long way to run, and
upwards,
yep. So I think this year and next year you'll see a significant resurgence in the gold price. How much is anyone's guess, but you know, figures have been touted of $1,800, $2,000 an ounce. Newcrest, the interesting thing about Newcrest is when you read that quarterly, their all-in statutory costs are coming down. So they're having great success in bringing their mining costs down. The thing I don't like about Newcrest is it doesn't hedge. It doesn't have any hedging whatsoever on its books. So when you're as big as Newcrest, they say, well, we are the market, we don't need to hedge. But my view about gold mining is that you always need to try and protect yourself against the downside moves.
So Kim, just rewinding a little bit, you said that you expect gold prices, the underlying gold price, to go to 1,800 to 2,000 US an ounce. Is that correct? What do you see as a driver of that?
I think it's volatility, Julia. I mean, we've just started to see this. We've seen. I mean, have a look at what's happened with cryptocurrencies. You've seen a lot of money come out of cryptocurrencies starting to go back into gold. I think increasingly, as people get nervous about where interest rates are going and they're looking for a store of value, gold can actually fit that bill. It's a rather barbaric way of investing your money.
I mean, we thought that during the global financial crisis, but it wasn't the case. We saw gold stocks tumbling with the rest of the market.
That's true.
It's going to be different.
That's true. I think the thing now is with gold, it's like across all mining stocks, and we've seen this with the big cap miners. The producers are much more aware of how they need to protect their cash flow to pay dividends to shareholders. So there's much more focus on the operational efficiencies of companies like Newcrest.
Now, Andrew, I haven't ignored you. We used to work together maybe about 17 years ago, so I'm guessing that your view on gold, not a huge fan, would I?
Look, I'm not a gold fan, and I would say that 17-year history has probably validated a lot of those concerns. I can remember as long as we've been talking about it, that these features get talked about, and they are true, but there is such a timing dimension to it, to my mind, that it means that it becomes far more speculative than I think people give it credit for. So you look at a company like Newcrest Mining, probably the best miner in the business on the Aussie market, and long-term investors have lost money over the last decade. They haven't even made money over the last 5 years, and that's a period where sales have grown strongly.
It's one of those stocks where you have to time your entry when the stock is out of favour. So if you'd bought Newcrest when it was down, I think its low was $7 or $8. couple of two and a half years ago, if you'd bought it and you'd held it, at that point in time where it was completely out of favour, you would have done extremely well.
Absolutely. So that was Newcrest Mining, and amazingly, Andrew and I started in the markets on the same day.
Exactly the same day.
In 2000. Much better times on the market.
Look at us now, Julia. Look at us now.
I've got to say, Julia, I think you've weathered the process better than me.
There's no denying that.
Coming up, getting a snapshot of your health with just a swipe of a finger. Our stock in a minute. Up next.
You're watching Equity Investor on Sky News Business. Welcome back to Equity Investor.
Must be soon. Yeah, I couldn't tell you a date.
Welcome back to Equity Investor. My guests tonight are Andrew Page from The Motley Fool and also Kim Slater from County Securities. And a reminder to write in with your questions or comments. It's eq@skynews.com.au or #investor. And if you want to ask your question live on air, include your contact number so we can ring you up as well. Now it's our stock in a minute. And a company that some say is the picture of health. This one is from Jonathan Howe, Jono from Red Leaf Securities, a company that specialises in small cap stocks. And I think they have a special relationship with this company. I think it's a client of theirs. But let's hear from Jono on why he likes MyPhysique.
Hi Jules, so the stock is MYQ, MyPhysique. What this company actually does is it is the owner and operator of an app that you download on your iPhone, and it takes a photo of you, both your front and side, and it tracks and records key measurements like your waist, hips, thighs and your chest. So this isn't only relevant for people in the health and fitness industries, but it's also relevant to, say, health insurers who are obviously looking to win more business, and if they can do that via providing an app that helps people have a reduced policy by tracking their weight loss over a certain period, then why not? There's also clothing and apparel companies that are potential B2B customers because they have a huge amount of online returns each year. Somewhere in the vicinity of about 65 billion US a year gets returned from clothing purchases that are online because the measurements just don't stack up. So if you had a customer that could download this app, get their measurements right first go and reduce that potential for them to return it, that would make sense for these companies. So they would be some key catalysts.
What a chart. Having a look at that company, and I think not too long ago the stock was just at 3 cents and you've seen a strong return there. But I guess just coming back, and it's around about $1.20, so from 3 cents to $1.20, eye-watering valuations. I think the market cap's around about $92 million, and given that this financial year, the forecast from Red Leaf is maybe revenue of about $80,000. You really are buying into this growth story. Yes, the technology is there, but I guess a question mark on, how investors value something like this. And, the catalyst, of course, is doing a deal with one of the big tech companies, having a big shareholder coming on board. Kim, would you be backing something like this? We've seen stocks like this.
I like the idea. I don't like the valuation. It's still got a cash burn of somewhere between $200,000 and $400,000 a month. It's got about 1.3 million in cash on the balance sheet. So if you think about that, they've got 4 or 5 months of operating cash flow in the bank. It's a very short time to actually win new business. They supposedly have some deals that are about to be done or are being done in places like India. I think it's a great idea, but you'd want to see a lot more. You'd want to see a lot more cash come through on the P&L to support that share price, or the valuation has to fall. And probably the catalyst for that's going to be a capital raise.
I mean, I'm one of those people, Paige, that I just don't like shopping. I like shopping online, but sometimes, fitting your
You should be trying being a bloke.
It's a problem. And look, they take measurements through the front camera in your phone. There's applications for perhaps the health industry, but also the weight loss industry and potentially the apparel industry. I know you've backed tech stocks in the past. One of your favourites have been Catapult, and you've backed that from very early stage. How would MyPhysique fit?
I think it's just a much earlier stage than where Catapult were. So is the tech exciting? Is the market opportunity huge? Yes and yes. I mean, that kind of has to be in place for them to successfully list on the market in the first place. It's kind of a necessary minimum. But as Kim rightly points out, there's not much cash there. They're burning through it very quickly. The other thing is on a diluted basis, you could almost double the share count. There's a lot of unlisted options there as well.
Convertible notes.
Convertible notes, I think, as well. well. So, and look, this is a tough game. I would personally, if you were interested, I would put it on a watch list and I would wait for those sales to sort of start coming through, because if they don't, there's capital raisings and there's a long way to come down, so hyper speculative.
I mean, just picking up on that, and that's one of the things that the US market does very well, value companies on revenue and sales and potential sales, whereas here in Australia, we tend to still focus in on net profit. So is it about revenue growth in picking the winners? Because there are quite a few companies now in the fin.
I think you've got to have the revenue growth, and they're obviously, I mean, the two sectors are, it's appealing to B2B and it's also appealing to the individual app user. So it's a great market. How many people actually want to really look at themselves as an avatar is another thing. But I think it's got a great addressable market. So what they really need to do is to tie up some global revenue deals, and once that's done, we can probably get a better idea of where the valuation of the company lies. But it's running on fresh air at the moment.
I'd also point out, so this is, as impressive as it is, the technology, they're not operating in a vacuum. They're up against the likes of Silicon Valley here. Let's put this in proportion. So if Amazon with its clout decided that they wanted to enhance sales through some app that did this, that they could develop that in a weekend to be ridiculously
We all want his body. Oh, not another though.
Yeah. But you know what I mean? So it is great. I like the story. I would just wait. It is very, very early days.
Okay, so it looks like our panellists just watching that revenue line and watching the revenue hopefully tick over quite aggressively before jumping in on the stock. And of course with these stocks you can just watch the number of downloads of the app as well.
Keep an eye on the quarterly cash flow. That's the critical thing.
And cash is king. Time to go to our next email. So this one says, could I please have your thoughts on Wesfarmers, particularly in the wake of today's major write-down? Oh, very topical question in terms of Wesfarmers. The darling of the market for so long was the Bunnings business. It was the jewel of the crown, and now, we've seen almost a $1 billion write-down from a few of its different businesses, mostly from Bunnings UK, Ireland. Kim, is now the time to be buying Wesfarmers?
I think the difference, everyone's been making the comparison between Wesfarmers and Masters. And I don't really think that's a valid comparison, because the difference with Masters in Australia was they were actually going from a standing start. Wesfarmers has bought an existing chain. So the mistakes that Wesfarmers have made have been with their product ranging and with the management that they've had. They've got the market offside. Now they've got to get that hardware market back on side in the UK, and that can be done. I think taking to the write-downs is a prudent thing. But if they actually sold the business now, they'd be throwing the baby out with the bathwater. I think with the right management in place, there's probably a pretty bright future for that Bunnings UK and Ireland business.
So a really good point coming through from Kim, and I guess just having a look at that existing business in the UK, we know that house prices over in London have been under pressure. Do you think that plays into a more difficult hardware market?
Oh, 100%, yeah. I mean, those two are very tightly related, as it is here, as it is everywhere else. So, I mean, I would be looking beyond the ups and downs of housing, frankly, these guys are making an investment for decades to come, hopefully. But yeah, you're right, it's absolutely a factor. It's still early days, but yeah, it's going to be a lot harder than they've had it here, I think.
It's trading at around about $45 now. What price would you be happy to buy in at in 2018, Kim?
I think somewhere around that 42, 43 level.
Okay, so not too far away.
Not too far away.
How about you, Andrew?
I'm more conservative. I want to go about 38 or so.
Okay, on that note, we hope you've enjoyed the program tonight. A big thanks to my guests, Andrew Page and Kim Slater. Andrew Page from The Motley Fool, and also Kim Slater from County Securities. And a reminder, you can watch the show anytime with Catch Up on Foxtel Go and on demand on Foxtel IQ. We also have a podcast which you can find at skynews.com.au. And don't forget, if you're overseas, we're available on australiachannel.com.au. I'm Julia Lee from Bell Direct. Thanks for your company.
Information presented on this program is general in nature. Viewers should seek their own professional advice before purchasing products or services. The producers of this program may receive a fee for commercial arrangements with companies featured in this programming.